Welcome to TMS Insights. It's early in October. Ben, we've had a really good year to date across markets here and around the world. There's been a bit going on, so we'll get into a macro sort of thing, what's been driving the markets overall, and we've got a few stocks to talk about today. So when we look at it, the ASX had a quarter about 6.5%.
Yep.
Was up. For the year, about 8%.
Yeah, one of the best quarters we've had in 11 quarters or 12 quarters?
11 years.
11 years,
yeah,
wow.
There you go.
Okay.
2013 before we had a better quarter. So it's big for us. Go back and look at the US markets. They've done better again. So the year-to-date performance on NASDAQ about 21%.
Amazing.
At 20% the S&P 500. So they're good numbers, aren't they?
They're amazing. And, you know, I think it's been interesting in Australia because there's been parts of our market that have been really unloved in the last quarter, and there's been parts that have potentially been a bit overly loved, but the overall index has been strong, and it kind of feels like it's continuing to be dragged along by the US markets as opposed to maybe, you know, a change in the profit outlook for a lot of businesses, which worries me a little bit in the short term.
Yeah, a great one to start with. If price goes up, it's either because its earnings go up or PE expansion.
Completely.
And we're saying that what we saw in certain sectors, and we'll talk about those in a moment, was more PE expansion than earnings per share growth. So, and that makes us a bit cautious about the rise.
And I'd say in America it's the opposite.
Yeah.
Whereas it is earnings per share growth which is driving their market.
And the different composition of the market leads to that. So where they've got the techs which have had the earnings growth, which means that Google's are on 18 times and things of that kind. Here, Commonwealth Bank, which hit record levels, and the bank sector's been amazing, that's been on low single-digit earnings growth. So it's PE expansion.
Yeah, completely. And then we've had the minus. And that's been the topical part at the end of the quarter.
And at the end of the September, the China thing came alive, mass stimulus, because they'd been a drag. All the miners have been a drag.
It's been, a lot of it's market positioning. You know, you go back a year and a half, everyone was saying Australia's probably going to go into a recession or very close, and you don't want to be overweight banks. And China is going to come running out of COVID, and you want to be, and we've got inflation, and the best place to be when you've got inflation is resources. It's the one thing that does well. And of course, it's the exact opposite has happened.
Banks have well outperformed, resources struggled.
Big time.
Inflation's declined. Clearly.
Everywhere in the world, inflation is now back into bands, except for Australia, or well on its way back into the bands. And you know, we've had this time where, you know, when I look at the top 20 shorts on our market, 17 of those a week ago were resource stocks. So we've seen, I think, a lot of fund managers underweight China, and then we've seen a lot of shorting, and then we saw the stimulus announced last week. Which
was in a response to, you know, an ailing property market, economy in China. Great thing about a command economy is you can change things like that. And they did. And the fortunes of China-facing stocks turned around midway through last week. And I think so when the big global institutional investors are wanting to get exposure to China, it is very rarely actually by buying Chinese shares because there's a lot of, you know, issues as we've all seen over the years. But Australia is seen as a China-facing market. It's liquid. It's got governance, et cetera, et cetera. So our market, it felt like just got a boost overall out of that, but particularly our mining stocks. The banks did come down in that though too.
Yeah, they did.
Some rotation.
Some rotation,
locally.
Definitely.
So fascinating. Obviously, since we last had our insights, we saw the Federal Reserve do exactly what they said they'd do and cut rates, and a number of other central banks around the world the same. The Fed did cut by 50 basis points, which was probably larger than overall expected, and they've signalled, and markets are expecting further cuts, which are supporting markets as well. Yeah,
so we're now moving into what is turning out to be a good time to be an equity investor. We've got economies around the world are typically holding up quite nicely, particularly America. And we're now in a declining rate environment, sort of the opposite of what we saw in 2022. So, there'll be questions as when did the RBA go? The bond market is still adamant it will be before Christmas. the governor of the RBA is adamant it won't be before Christmas. Yeah. So that's quite an interesting one in itself.
And so they meet twice before Christmas. The next one's on Melbourne Cup Day. They have CPI out a week before that, and that will be the trigger point for my way.
Because there's nothing between then and
they have a December meeting, and then they won't meet in January. So
and no big prints or anything. No big prints.
The CPI in October 30 is the big one. So and that will be case closed or what have you. So a lot will hinge on that. So at the end of this month, we'll be certainly watching the data prints. But we've also been watching some stock specific news. There's some companies that report out of cycle, like one of our favourites, Soul Pattinson and Brickworks, which reported last week, Ben. Again, confirmation of their longer term thesis, but a good bump in the Brickworks share price afterwards. Yeah,
that was the one that really moved. And I think that was on the news that particularly some in the Brickworks Property Trust, which is this huge industrial property trust that they partner with Goodman Group. They said that they'd seen a stabilisation in valuations. Some very strong rental activity was happening across those properties. And, when you go back about a year ago, there were some properties, I think they reduced the overall book value down by about 10% across those.
Pretty conservative probably.
Yeah, I'd say so. And then also the building space at the moment, we all know, is like just a mess. It's problematic. But they are adamant that we are coming into what could be a once-in-a-generation building boom. And not just here, but in America as well. So, which they've got a decent-sized business over there these days.
Yeah, in the southern states, which are growing faster than the rest of the country. So that was good. And obviously Soul Pat's a good increase in their dividend, which people enjoy. 24 years in a row increasing dividends, the only company on the ASX that's done that.
And actually accelerated in recent years. The amount of I think it was up more than 10%.
54 cents. So really good increase in the dividend there. Fascinating to watch the news play out on REA Group. Obviously a favourite. We've talked about a lot here. They had a great result, hit a record high share price wise. A week later announced they were going to try to buy Rightmove, basically a UK-based equivalent. And they went through a few bids, incarnations, and eventually on Monday this week, News Corp, their major shareholder, and REA Group walked away from Rightmove.
Which I think with the price they were getting up to was the right move from Tish. But yeah, look, having read and looked at this business a bit over the last month, you could see where they were coming from. The UK property market is some way behind the Australian property market, ironically, and rolling out the monetisation model that REA has done so effectively here, it could have been could have had a lot of value for shareholders, but it's got to be at the right price.
And they had to, 4 bids they basically
Four bids against themselves.
Basically, nobody else lining up. So what happened interesting share price wise, no surprise, on the bid REA Group fell, let's say 10%, under $200. It's taken that up halfway, went up 5% I think on Monday when they removed the bid.
Yep, and under UK takeover law, they now can't do anything for 6 months. BHP's run into the same thing with Anglo. So it's, I think we've got some clean air now and focus back on the Australian business, which I think is an absolute sweet spot at the moment with listing volumes and a good housing market and probably right where they want it to be.
And this is the point that investors probably were a little concerned about, Ben, is that you've got such a great business. Don't make an acquisition and potentially pollute earnings, which Australian companies have got a bit of a history doing. Hey, we'll go offshore and they find a way to rip up a few $1 billion in the process.
Yeah, completely.
So that's good. Now, just more broadly, what are you seeing? I mean, we're in that relatively quiet time now. We obviously probably a lot of focus on the US presidential election with the month to run. We talked about some of the macro things. What else should be investors looking out for at the moment?
Yeah, I think that there's not a lot of company news as we've sort of identified there, and we are going to look. There's a couple of things that we are coming into a period of the year where historically markets are strong that run into Christmas. Typically, not every year. I mean, bearing in mind, September is always
and it was
historically the worst month of the year, and we've just had a great September. So these things can flip. So good time to be invested typically in this period, but it could be different this time. The US election, I think, will create some short-term volatility, but I think it's something that people can get a bit carried away with is the president. It ultimately will matter for little.
It won't affect many company earnings.
No,
this is the point. So it'll be a lot of newspaper print and stuff.
The market would like a Trump win. It might not be what everyone would like, but from the share market point of view, you would get a bump in the market. But I don't think a Harris win is anything to worry about. So it'll get a lot of journalistic fodder and all that sort of stuff, and a bit of movement around it, but it's not something we need to worry about.
Geopolitical events, we're having Iran at the moment. This is all playing out. We've seen, many conflict issues in markets can briefly impact, but they don't sustain those impacts generally. I'm sure people are concerned about it. Naturally, it's not good to watch, but from a market's point of view, obviously oil had a big bump overnight, I think, so risk assets can get sold off briefly, but generally speaking, it's more about the longevity, isn't it? Back to earnings.
Unfortunately, we've got recent examples. Russia went into Ukraine, held attention for about a week. Israel went into Gaza, ditto. You've got to separate market from this.
Markets will look through these things generally, correct?
REA's not going to suffer any change in their profit outlook as a result of this, and therefore the value of the business shouldn't change too dramatically either.
Great. All right, well, that's all we've got time for today. We'll be back with another Insights next month.